Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global landscape and also how we're currently positioned. As all of our clients know, on a regular basis we make adjustments to our global tactical portfolios based upon a very well-defined investment strategy that's been proven not only to reduce risk but also help increase return over the longer term. I think the biggest portion of our portfolio when I look at risk management, especially today, there's so many investors, we've heard about obviously the fiscal cliff last year, sequester this year, these were all moot points. I talked about that repeatedly throughout my video updates. Currently we're positioned mainly in, and we made some adjustments to this allocation of course at the end of February going into March. Predominantly, we're in small cap emerging markets. By the way, small cap emerging markets greatly outperforming large cap and general emerging markets. What I want to stress is relatively stronger investment sectors outperform and give less risk. Relatively weaker investment sectors give more risk and lesser performance. So that's why we make our adjustments when we do. The other portions of our global tactical are predominantly in the U.S. equity-based ETFs between small, mid, and large. Again, these are also outperforming almost all of our base sectors. As we've done about 3 months ago, we sold our gold position. And I've had a few people say, why just sell gold? I thought gold's a great hedge against inflation. Well, guess what, folks? We're not having any real inflation, and gold's been going down. Since we sold our gold position, gold is actually down about 10%. We replaced it actually with mid-cap in the U.S., which in the same time is up about 6%. So again, you're talking a 16% spread. The reason we run our strategy, it's been proven to work not only in good economies, but also in bad economies. It helps adjust in sector rotation based upon what's relatively strong. Again, risk management is an important part of what we do. On our income side, we continue to own our royalty trust, our publicly traded mortgage-backed security REIT ETF. We continue to own emerging market bonds in some of our income-oriented accounts, and we also own preferreds and high-yield global bonds. Traditional fixed income bonds like treasuries, like munis, like straight-up corporates, we really have very little or no exposure in these at all. I've talked about these repeatedly, that these are going to be your biggest risk asset. I firmly believe investors who own traditional bonds or mutual funds or ETFs that own traditional bonds like munis or treasuries or long-term corporates are going to have very mediocre performance or no return on that bond portfolio the next 3, 5, and 10 years. Again, I firmly believe that you're going to see interest rates stay at a flat line or slowly go up after 3 years. And if that's the case, investors that own bonds, traditional bonds, are going to be big losers. You have to understand, bonds have risk just like equity markets. I talked a few weeks ago, FINRA, that governs the overall brokerage industry, actually sent out an investor alert telling you that bonds will actually drop in value 10% if interest rates go up just 1%. So again, I want to warn investors, of course non-clients, because our clients were handling that risk part of it. But if you're not a client and you still own a lot of these bond funds, traditional bonds, muni bonds, or treasuries, I think you're really in set up for a world of hurt and really low returns or no return over the next 3, 5, and 10 years. I think investors need to understand what worked in the past does not necessarily work in the future. Past returns are not indicative of future results. So what that means is if you're buying a bond fund that had a spectacular return the last 3 or 5 years because interest rates were going down, you're not going to see that same type of return going forward. Interest rates and bonds are like a teeter-totter. When rates go up, bond values go down. We're at an all-time low historically in interest rates. That means either low interest rates, low returns under inflationary numbers after tax, and or if rates go up just even 1%, you could lose easily a 10% corresponding decrease in the value of your portfolio if you own just an average maturity bond or mutual fund of 10 years. The longer the maturity, the more downside you're going to see. Hence the reason why we do not own traditional bond funds or traditional bonds within our client managed accounts. I think investors greatly need to understand that if you don't have an investment strategy and you don't follow it, the best you can hope for is mediocre and a lot more risk. That's what we're looking at right now for a lot of non-clients that we talk to on our radio and TV show. By the way, we do have a live TV show tonight in Southwest Florida, and one of the things I do want to announce is if you can't watch our live TV show, the next morning around 10 a.m. it will be actually downloaded on our website. So you can go to our media center, click on tonight's show if you couldn't watch it via live. So this is a great opportunity not only for our clients who can't get that broadcast, but also for non-clients. Of course, if you're a client and you have a question, please call our office. And by the way, if you're a client, we appreciate your referrals and your business. If you're not a client and want to experience the difference that Resnick Wealth Management offers, call our office for a consultation. There is a difference. We invite you to experience it. Call our office for a consultation, and make sure you listen to my live TV show or watch it tonight. And of course, we will have a live radio show this Sunday. Have a safe and profitable week.